Hey folks, so in this video I want to talk about Tyson and I want to start off with the technicals. So Tyson, they reported earnings not too long ago and this thing fell off a cliff. So right now we're at about $49 and before that, right before earnings, we were slightly above the 50-day moving average right at 59.15. So this essentially just fell like 10 bucks. A little bit more than 10 bucks actually, but yeah, you get the idea. So before that, we were just moving in this channel. So if we're just seeing right here, we got this support down here, we got this resistance up here, and like I said, we were above that 50-day moving average. It was looking okay. So if earnings was actually okay, it would have been fine. And obviously earnings was not okay, and we knifed below. So right here, I also have this fib retracement. I'm looking at the pandemic lows right here in 2020. And I'm also looking at the most recent highs here in 2022. So if I'm drawing that fib retracement level, we actually cut right below that 78.6% retracement level, which is right around at 52. That happens to coincide with where this trend line is right here, that support trend line. So would it surprise me at all if we rebound to 52? Not at all. That would not surprise me. I actually expect it. But I don't necessarily know if we're going to get there right away or if we're going to continue selling off a little bit more, because oftentimes when you see a strong sell-off like this on earnings, it could see some more continuation. But another thing that you do want to focus on is the RSI. It's very oversold right now. It's at 19.56, which is a pretty darn low reading. We've seen these readings before on Tyson. Right back here in September of 2022, we got this reading. It was pretty darn low, and it had a small pump, and then it flushed again. But shortly after, we did have a pretty big relief rally. And you can see that right there. The RSI definitely straightened out again, only to sell off again. So are we going to have a dead cat bounce here on Tyson in the near future? I think so. But the question is, how much more are we going to sell off before we see that? So that's always one thing that you do want to take into consideration. Now, what happens if we just continue knifing down? Well, it wouldn't surprise me if we reach these COVID lows either. We're not too far away from it. We're about $10 away from that. But ultimately, I do think that at some point in time, we are going to retest that 52 level. And I don't think it's going to be all that far out in the future, just given where RSI is right now. So that basically covers the technicals. Now let's go ahead and actually see why this thing is selling off so hard. So I'm going to bring up the second quarter earnings results. So right away, first thing I have highlighted right here is operating income, which is actually not operating income, it's operating loss. So if we're looking at sales right here and we're comparing same quarter, different year, we're looking at 2023 and 2022. Sales are flat. So we're not really growing here, we're not really declining a whole lot. So if we're just looking at operating income or loss on the other hand, there's a huge difference. So in 2022, we had $1.15 billion of operating income. 2023, however, we have negative 49 million. So that's obviously not good. Now, what about earnings per share? Well, earnings per share also sucks pretty bad here too. So we have negative earnings per share of 28 cents. And the last year, we have positive $2.28. So yeah, earnings per share is taking a dump. Now let's scroll down a little bit and let's look at the segment results. So Tyson, they break it down to beef, pork, and chicken, no pun intended. So right here, if we're looking at beef, this is about 4.6 billion. Let me just zoom in a little bit. So right here, you can see this is 4.6 billion right here in 2023. 2022, I guess people were feeling a little bit more rich, because we were seeing beef sales of about 5 billion. Now look at pork. Pork just declined a little bit, but take a look at chicken here. So hey, guess what? You see beef sales decline, but you see chicken sales increase. So yeah, chicken sales are $4.43 billion versus $4 billion in the last year. So right here, there's a very clear picture that's being painted. Essentially what this reads to me is, hey, you know what? Maybe the consumers here aren't feeling all that great. Maybe beef prices are a little bit expensive. Maybe they're running to chicken instead. Now, if you're asking me, I buy all my beef at Costco. So let me just show you some real quick pictures on the side here. So I just got to show off how cheap I'm getting this beef. So I am actually going to Costco. I'm buying brisket, and this is USDA Prime. Look at that. It's $3.49. So this was actually just a few months ago. So, I doubt that the price went up a whole lot. Now, if you're buying something like brisket, there's a lot of purposes for this. You could slow cook it. You could grind it into ground beef. You could smoke it. You could do all these different kinds of things. So, you don't necessarily have to pay $10 a pound for beef. You could just eat a different cut that's still pretty good. And yeah, look at that, USDA Prime. So yeah, USDA Prime. I mean, you're getting USDA Prime for about $3.50 a pound. If you take out all the fat, that comes out to be about $4 a pound. But there's a lot of different purposes. Let me just quickly show you. So right here, I have it cut into slabs. So right here, you could clearly see, brisket flat right here. This is great for smoking. It's great for soup. It's great for just cutting into chunks and braising. You could go ahead and grind it like I did here. You could get ground beef. And you could even thinly slice it like this. You could do like a Korean barbecue style. And this machine right here, it's a meat slicer, handheld meat slicer. It costs about 70 bucks, but it pays for itself. If you were to buy the meat like this, thinly sliced, that's going to be like $10, $11 at an Asian grocery store. So just some quick ideas here. This doesn't all have to be about stocks and earnings per share, all of that stuff. We could just also talk about how to save money like this. So going right back to the financials. If we're looking at prepared foods, this is where their money is actually being made. So right here, prepared foods, we can see that the sales here were actually a little bit higher. It's 2.42 billion versus 2.39 billion. So there is a little bit of an increase here. Now, let's just scroll down a little bit. So if we're scrolling down, now we're seeing the operating income and loss for these different segments. Beef, they didn't even make money on beef. So it's pretty much $0 here. And if you're looking at the 2022 margins, this was a 12.7% margin. So it was their highest margin item. Now it's literally ZERP, nothing. If you're looking at pork, they lost money. Yeah, this used to be like 3.8% margin in 2022. Chicken, they lost the money. This was like a 4.8% margin. Prepared foods, hey, you know what? They actually made money. So this is the only thing they're making money on. So everything else, they're either losing money or they're breaking even. So this is pretty cruddy. Now, if you're looking at the prepared foods, the margins actually went down here too. So 11% versus 10% right here. So definitely some things to pay attention to. Now, let's just scroll down a little bit. And now we're going to look at their outlook. So I got to zoom out a little bit so we could read this. If we're looking at beef, it says that we anticipate an adjusted operating margin of -1% to 1% in fiscal year 2023, as margins are expected to decrease. So they're literally just speaking in doom. Yeah, that's the best way I could say it. They're speaking in doom. So nothing here looks good. They're saying, hey, you know what? We're either going to make -1% or +1% on margins here. So basically zero. And if we're looking at pork, they're saying we anticipate adjusted operating margins of -2% to 0. So yeah, they're saying, hey, you know what? There's no way in hell that we're even going to make money on pork. Now for chicken, they're saying we anticipate an adjusted operating margin of -1 to 1%. So hey, it's like, hey, we'd be lucky if we even make money is kind of what they're saying. Now for prepared food, they're saying 8 to 10%. So yeah, this is pretty much their bread and butter here. So yeah, I mean, this is a company that sells meat, but what they're making money on is the prepared food. So yeah, it's pretty funny to me. Now, if we're looking at revenue, it says right here, we expect sales to be 53 billion to 54 billion. So what is this in comparison to? We want to look at 2022 data. So they're saying basically 53.5 is the middle. So if I'm going over here and I'm looking at Tyson Food revenue, what was 2022 revenue? It was 53.28 billion. So it's essentially unchanged. It's flat. So let's go back. Now, if we're going down a little bit more, they talk about liquidity. It So they say we expect total liquidity, which was approximately 2.2 billion in April 1st of 2023, to remain above our minimum liquidity target of 1 billion. And they said on May 3rd, 2023, we entered into a $1.75 billion of new term loan facilities. So obviously, this information is important because Tyson, they do pay a dividend. So we're going to see that when we go down here. So now we're looking at the consolidated statement of income. And let me see if I could zoom in here for you guys. So if we're looking at this, sales, obviously sales is flat. Cost of sales, however, is significantly higher. That is essentially what's causing us to go negative. Now, basically after cost of sales, our gross profit is only $527 million. And our selling and general and administrative is higher than that. That is why we have an operating loss. So going down the line, at the end of the day, we have a net loss of $91 million. Whereas last year, same time, we had $833 million positive. So going down a little bit more, we can see diluted shares outstanding. This number is actually going down. So it was 364, what is that, million? Yeah, it's got to be. So yeah, 364 million in the prior year versus 354 million now. So it went down by about 10 million. Now, if we're looking at the earnings per share, it's negative 0.28 versus positive 2.28. So obviously that looks horrible. Now, what about dividends? So dividends actually went up a little bit. So dividends are now 48 cents. So let's just go ahead and let's annualize that. So pull up the calculator. 0.48 times 4. And that's $1.92. What is Tyson trading at right now? It's trading at, let's just say $49. So $1.92 divided by 49. What is that? That is a dividend yield of 3.92%. So honestly, that's not too bad because you have to remember that, in this environment, the interest rates might be high for the 2-year or the 1-year treasury bills and notes, but that's not going to last very long, especially if the Fed starts cutting interest rates. So, 3.9, that's not bad. But here's the thing. If they're losing money, is this dividend sustainable? And the way that it is going to be sustainable is if they continue to borrow money. So obviously, if they're borrowing money, they need to pay interest on that. So that's going to be increasing their interest expense during a time where they're not necessarily having favorable gains. So let's just go back to the financial statements. Let's scroll down a little bit more, see what else we can find. So now let me just zoom out so you guys can see this. So if we're looking at the balance sheet, we can see that they have cash and cash equivalents of about $543 million. Accounts receivable of about $2.4 billion. So in very liquid terms, they have about $3 billion. Now they also have an inventory position of $5.5 billion. But, people have to eat. So obviously their inventory is going to eventually sell out. So, you always got to remember that. It's a little bit different than merchandisers because, like I said, people, they got to eat. So, this inventory is likely going to get whittled down. So I wouldn't worry too much about the inventory situation. Now, if we're looking at total current assets, that's about $8.89 billion. If we're looking at total current liabilities, that's about $5.34 billion. So current assets do exceed current liabilities. So let's continue to scroll down here. Let's look at the consolidated statements of cash flow. So right here, we can see that when we add back in depreciation and amortization and all of these other non-cash items, it actually looks like our operating activities, cash from operating activities, is $769 million. Now, if we're looking at the additions to property, plant, and equipment, that is a negative $1.01 billion. So, overall, our free cash flow is actually negative. So that's not looking too good. Whereas in the past, if we get this and we get that, it's positive. So we have negative cash flow and we're paying dividends. That's not always a good thing. Now, if we're looking right here, they are repurchasing common stock. They spent about $332 million on that. As far as dividends, they paid out about $336 million worth of dividends here. And when we're looking at their beginning cash position and their ending cash position, yeah, it's looking a little bit tight. So we went from about 1 billion to about 543 million. So, if you were to buy the stock for the dividend, there definitely is just a little bit of risk because, they might cut their dividend, maybe, maybe not. It depends on how long this issue that they're having is going to continue. And, maybe we could get a little bit of insight on that from just reading the actual transcript from their earnings call. So I do have a little piece on that. It's from Motley Fool right here. And going back a little bit, it says right here, the CEO is saying, I want to point you to 3 important things on the macro environment. So let me just go ahead and read these bullet points for you. It says, first, marketing conditions remain very challenging. Commodity prices for the most fresh chicken cuts are much lower than last year, with boneless, breast meat, tenders, and wings down more than 50%. While we are not fully exposed to commodity markets, we are not immune to their dynamics. Some might expect these dynamics to impact our results immediately, but in fact, they work through on a lag. As chicken commodity prices declined in Q1, the impact continued into our Q2 while prices increases we saw during the quarter are expected to affect Q3. Second, input costs were higher compared to last year as our feed ingredient costs increased 145 million. We also realized an unfavorable year-over-year derivative impact of approximately 135 million due to volatility in commodity grain prices. So yeah, obviously, volatility in commodity prices is not good for them. So going down to their third point, while high path avian influenza has not had a significant impact on our live operations, key export markets remain closed. While we can't control markets, we are focused on the things we can control. We made a series of strategic decisions to better position us for the future. For example, we converted 2 of our 3 plants from bone-in to boneless, specifically to add new business and to continue growing with our important customers. So what did we essentially get from this? They're saying, hey, chicken commodity prices are declining. Hey, there's volatility in commodity grain prices. And hey, this is affecting us quite a bit. So that's essentially how I read into that. And we can definitely see that just from the cost overall. And I'm sure that, just because wages are going up as well, that's definitely hurting their bottom line on that as well. Now, one last thing that I want to look into is earnings per share. So obviously, this isn't factoring the last quarter. They don't have that information in there. But it was about negative 24 cents, I think. So, just look at the prior history. So when things were good, they were making about $3.71 a share and $3.07 a share. But you can clearly see that there is a downtrend here. So from September 30th of 2021, this was kind of the high. After that, it started declining. So $3.07, $2.28, $2.07, $1.50, 88 cents, and then, the negative 24 cents or whatever. So this is going through a downtrend. But keep in mind that what Tyson is facing, they're facing macroeconomic issues. This company, it goes through these highs and these lows. So, you might just be thinking, oh, okay, well, I'm going to calculate the trailing 12 months earnings per share, or I'm going to look at the forward earnings per share and all of that, and then I'm going to calculate forward price to earnings, this and that. But you have to remember that this is a cyclical stock. So, it's going to have good times, it's going to have bad times. You want to buy the dip on the bad times. Is this the right time to buy the dip? I'm not necessarily sure, but I don't think it's expensive right now. Especially if these if these headwinds slowly start to fade out when the economy does get better, because the economy is not going to stay complete shit forever. Things are going to get better eventually, and companies like Tyson, they're going to benefit off that when the consumer is feeling a little bit more confident, and when inflation issues start subsiding and supply chains get a little bit better, commodity prices aren't all wacky and all over the place. So, things will get better for Tyson, but in the shorter term, they look very, 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 very negative. So, if there's a time to buy Tyson stock when it's falling, it's likely going to be 2023, when they're literally telling us that they're not going to make money on beef, they're not going to make money on chicken, and they're likely not going to make money on pork either. So this basically sums up this video. I hope you guys found it helpful, and have a great day.